Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for June 28th of 2021. Please see our disclaimer for important information. Well, it's good to be back after a week's break, a well-needed vacation, and we've had relatively little movement in some of the data, most of the data, in fact, over the last couple of weeks. But here we have our high-frequency data tracker from First Trust. You can see that the numbers are really picking up some steam in a lot of the areas. We've got some detail in some of these components, namely hospitality, restaurant, dining, etc. TSA checkpoint data. You can see that over the last month, that data has been very strong. A lot of it has to do with this continued reopening, reemergence, people more comfortable getting out. And plus, it's the summertime too, so there's a lot of mobility. In my own travels this past week, I could see that the restaurant activity was extremely active, a lot of people out moving around, walking in walkability areas, walkable areas, I should say, and shops and things were filled with people. So there's a lot of activity going on. And you can see that that's very much in evidence here. And even on the production side, we've got some Kansas City Fed data, which also mirrors some of the market data that we saw earlier this week on durable goods, industrial production. All that data is really strong right now. You can see that in the rail car traffic numbers, steel production numbers, so on and so forth. And we're continuing to get relatively decent job information. Here's a quick check on retail sales. It looks at both the year ago numbers as well as what we're tracking this year. That's in the dark blue line. You can see an acceleration of sorts as we've entered the summer months. Again, it's really not relevant to compare these necessarily against 2020, but rather 2019, which is a gray line. You can see that we're really breaking out and showing some momentum in retail sales. That has a lot to do with consumer confidence, has a lot to do with incomes, actually, improvements along the labor front. But what's interesting here, if you look at the right-hand side, this is retail sales data that tracks other areas. And as much success as we're enjoying here in the U.S., clearly that's not necessarily the case in some of these other areas. UK has been very strong, but in the Eurozone as well as Japan, you can actually see them flagging and maybe even reverting back a little bit using December 2019 as our baseline. So obviously it's a synchronized recovery, but I'd say it's definitely an evidence here that the U.S. is leading the globe in terms of its breakout and its economic emergence. Here are some more of the high frequency numbers. You can see hotel occupancy taking a turn up as we get closer to the 2019 number. Again, if you look at it on kind of a trend line basis, we're really getting close to that. In fact, we're accelerating beyond a point that we would actually normally see right now, and that's very healthy for the hospitality sector. The TSA checkpoint data, you can see that beginning to move higher as more inventory is being let onto the marketplace. More of these idle planes and capacity are being put back out onto inventory. And then open table, you can see that that's tracking very well and actually, frankly, a leg up here lately. It's a good time to take a quick check on the labor market. We've got two things here on this slide. One is on the left-hand side is total initial claims. So these are new claims that hit every week, and the chart on the right represents continuing claims, which tracks things over time. These are continuing claims that follow initial claims. And what you can see here on the left-hand side is that the labor market's in a good spot. Now, we've just ceased to continue to improve at the pace that we've been accustomed to over the last year. But that's not necessarily bad because we've reached a point where we're below 500,000 on new initial claims. That's still a point that we thought that it would take us longer to get to, but that we're here now, and we're seeing kind of some consistency in the data, which I think is actually pretty positive. Now, if you look on the right-hand side, most of the continuing claims are still kind of stuck in that emergency benefit categories, and you can see if you back that out, that regular benefits, as it were, have continued to come down, and that figure is again, it's just as high frequency as the initial claims, which we essentially get on a very regular basis, but it's very telling in the sense that the continuing claims are dropping off. Now, that sometimes means that people are exiting the workforce, but it also means that people are finding jobs, and there's more labor mobility out there as we have an increased number of job openings. As you'll see in a minute, we've had a really strong ramp in our quit rate. And here is that quit rate that I mentioned from chart R. What's really interesting here is that we've had a spike that has taken us beyond levels that we've seen in a long time, in a very long time, as a matter of fact. So here, I think in one chart kind of sums up the state of labor mobility, as it were, that there are a lot of folks out there that are confident enough in their ability to change jobs that they're actually quitting at a higher pace than we've seen. And so there's more labor mobility. I think there's still choke points in hiring out there. They're perhaps not necessarily as acute as we've seen, but in the last chart, the last page that you saw where we had continuing claims drop, and this chart right here, I think, tells you that there's a certain degree of health within the labor market. Now, kind of trending more into some personal finance areas. I mean, we've talked about retail sales just a couple of minutes ago, really strong. Well, you don't have retail sales unless you have consumer confidence. And here you can see in the upper part of this chart that we continue to trend higher in consumer comfort, consumer confidence. Weekly personal finance index continues to trend higher. These are fairly strong numbers, coming off of a kind of an awkward year, but actually showing some momentum. So when you talk about the consumer representing 2/3 at least of your economy, it's very important to see these numbers trending in the right direction. Here is the durable goods numbers that I alluded to before. What's interesting here is that even though the orders themselves, again, they're positive, which is great, and we've had some really strong rebound numbers that you'd expect coming off a really deep trough. And we expected those numbers to remain positive and maybe drop off a little bit, and they have. But what's really interesting is on the left-hand side in the lower quadrant there, if you will, you see the dollar value of those durable goods has really spiked. Really interesting to see that. Represents large items, large ticket items, and these are could be appliances, it could be autos, it could be a lot of different things. And over on the right-hand side, you can see the another representation of this, and the white line excludes transportation, and you can see that was up 0.3% in the last reading. The durable goods line, the green line, represents the more basic durable goods. That was up 2.3% month over month, and that's over on the left-hand axis. Again, these numbers are really strong and really symptomatic of a healthy economy. This slide, we've got a lot of data that I alluded to a little bit earlier. This is data from the Kansas City Fed. And what it gives us is a lot of insight into the manufacturing sector. And we've been monitoring this for some of these supply bottlenecks and choke points and supply chain constraints and things like that. And I think it's all still at play here. What you can see is the index itself is really high. We know manufacturing's been very strong. That's in the upper left. In the upper right, you can see prices paid for intermediate stage produced goods, as well as price received down on the lower right, are both exceptionally high. Even though they might have come recently just off their absolute peaks, I mean, they're still, from a relative standpoint, exceptionally high from anything that we've seen over the last at least decade plus. In fact, you almost say almost 20 years. And so what this means is that producers not only have the input costs moving higher, but they also have pricing power, and they're getting pricing in the marketplace. So this is kind of a tectonic shift from where we've been over the last decade, in which we haven't seen prices move that much, because if there have been what we call these transitory inflationary moments where input costs go up, generally speaking, producers have been able to absorb those into lower margins, but now they're actually pushing those out into the channel, into the production channel, and they're actually getting pricing. Now, the other thing that's imperative in this analysis too is that lower left, and that's supplier delivery times. And so we know lead times have been really long because of the choke points, because of not only the container situation, but the availability of resource and materials, hard commodities, things like that have been in short supply. The semiconductor issues have been well documented there. So, I mean, all of the things that we've been talking about over the last couple of months are still in play here. But what's the interesting dynamic, we didn't know 2 months ago, is whether suppliers and people within the channel would be able to get the pricing that they're pushing out within that channel, and they are. And here's another look into that supply chain, if you will. This is a kind of a quick look in trucking rates. And so these are different kinds of trucking rates, whether you've got flatbed, van, and then kind of a composite figure all together. Now, the numbers in this are not necessarily as important in the analysis, but the relative changes are. And you can look at, this data series starts in 2014, and we haven't seen numbers this high. Even back in 2018, transitioning into 19, when we saw kind of a spike, another kind of supply chain constraint that had some things to do with the trade wars, et cetera, and tariffs. Even that didn't reach the levels that we're at right now. Now, it could be argued, as you look at the latest data in this series here, that we've kind of come off these absolute peaks, but again, just like we said in the last chart, the relative levels remain exceptionally high for trucking. So the big question here that's being put forth by Arbor Research, which is a source of this, is whether we're peaking in these trucking rates. And even if we are, and we begin to track down a little bit, it's clear that input costs related to moving goods around is still going to remain high for some time. This is a chart from BKA Research, which I thought was really interesting. And I love BKA. They're out of Montreal. They do wonderful work. This is showing kind of an overlay of the economic surprise index for the composite of the G10 economies. That's in the solid line. And then they overlay that against China and their economic surprise index. And, what we've seen here lately is that China has stalled out a bit in economic surprise. And in fact, they've had perhaps more negative surprises, if you will, than they've had positive as of late. Again, you could argue that this is kind of the ebb and flow of a very large economy that doesn't necessarily move on a dime, that may be kind of self-correcting in a matter of speaking. But it's important in this analysis because you can see that there is a positive relationship between these two. And so this argument that BKA is making, that where China goes, so too will the G10. The G10 economies represent basically the largest 10 most developed, most integrated economies in the world, of which obviously the US is a part. So the hypothesis here is that perhaps, since China could be slowing by virtue of the data, does that imply that there's a global slowdown? And so I don't show this necessarily to suggest that we're going to have a global slowdown, just to highlight the fact that there are always going to be data points that are going to confirm your thesis, and there are going to be data points that don't necessarily confirm your thesis. And this might be one that says, you know what, we might be, apt to slow down globally. But I think if there is a soft patch here, it's not going to be that big of a soft patch again, as long as we can manage the inflation picture. And speaking of inflation, here is the Consumer Price Index 2-year percentage change. And you can see that in the blue. We know that's moving higher. Fed funds target rate, which is in that green. This is kind of a composite overlay from a piece that Liz Ann Saunders put together for Charles Schwab. And I thought it was interesting because it overlaid all of these things that kind of we worry about, kind of wrapped into this bundle of inflation and interest rates and what's the Fed going to do. And we've got some more some data and basically some data on the expectations for Federal Reserve rate increases. But right here we know they're still flat. They telegraphed this to the cows come home that that they're going to let inflation run for a little bit, and we see it moving higher. Wages and salaries, again, it's a 2-year percentage change, and we've seen data that's this high. We've seen it track for a while. We know wages have gone up and then they went down, and now they're kind of reattaining kind of this normalized trend line that we've seen perhaps over the last 5 to 7 years, and that's not necessarily a bad thing. We do want to see wages move higher because then that implies increased spending power, increased savings, a lot of positive second order impacts from that. But you can see here that having that Fed funds target rate flatline kind of goes against this. And again, Fed policy sometimes moves at a lag, at a rather significant lag to what the data is showing you, and I think that's again the case here. But not to say that we should get all worked up over inflation, because what we're seeing is kind of, again, to use that word symptomatic, it's very symptomatic of an improving economy that's getting, that's working on all cylinders right now, and having that inflation pick up a little bit is not a bad thing at all. All right, a quick snapshot on the housing sector. So what I'm going to show you are 3 things, and we've had some tailing off here in both new and existing home sales. Prices continue to go up. That's in the lower left. We're about 375,000. This is a national number, data compiled by Macrobond. The upper left-hand corner, I think, is something that it really caught my eye, because it looks at a 10-year trend, and it does kind of the line of best fit here. And we did get really ahead of ourselves in 2020. And actually, you can see that on the right-hand side for the Mortgage Bankers Association Purchase Index. And that number in red, you can see is head and antlers, especially in the second half of the year relative to this composite from essentially 2012 to 2019. Now we're kind of falling back in that 2019 in terms of the absolute volume of transactions as reported by the MBA. And you can see that again on units up in the upper left. And so what this all tells you, and the argument that's being made by Mizuho in their research piece in the upper left, is that we're falling back to this 10-year trend line, and that we're working ourselves to that 10-year trend line. And I haven't seen that type of analysis before, looking at it on a trend basis. Just, most of what I've seen has been on this flat year-over-year basis. And I think that's important, but looking at the trend line too, I think is also important. But clearly, we're still struggling with the notion of selling prices being higher. This is something else that I thought was very interesting. It's the shift in the lender mix now. And we've seen a dramatic rise in the number of non-banks that are participating, like a Rocket Lawyer. It's not to say that it's unhealthy to have that. It's just interesting to see that over 60 to 65% of all new mortgages are originated by entities other than banks. Here's a quick snapshot of our 2-year government bond yield, and with the latest Federal Open Market Committee by the Federal Reserve and their comments suggesting that perhaps the first rate hike might come sooner because of inflationary some pressures there. It's pushed up our 2-year yield rather appreciably on a relative basis as of late. This is a quick chart on net foreign purchases of long-term treasuries, and I define long-term as beyond 10 years. And this is an interesting dynamic because foreign purchases dropped off dramatically, and now you can see the demand has really picked back up. And the dynamic here is interesting because there's been a lot of discussion on the fact that 10-year treasury yields, which kind of in a very general sense hover around 1.5%. They've remained relatively sticky despite this increase in inflation. Again, there's a lot of reasons behind this, but a salient input into that might be the fact that we've had increased demand from foreign buyers of treasuries at a time where we're issuing more treasuries, which is essentially creating more demand, which potentially is raising prices and then keeping a lid on interest rates, on yields, because prices move inversely from yields. A chart from Deutsche Bank, which I thought was really interesting. It's an excruciatingly long time series going back to the beginning of the 19th century. But what's really interesting here, this plot of 10-year real yields. Now, again, real yield is the nominal yield, or what you see published in the paper as a yield, less inflation. So right now we know we have negative real yields. But in the light blue, you can see federal debt held by the public, and you can see during times where we've issued a lot of debt and we've had more debt held by the public, that you tend to see declines in real yields. And when you've had very noticeable periods of federal debt held by the public, i.e. issuance, you actually see negative real yields, and that's where we are right now. Question is, how long does that last? How does it exacerbate and get worse from here? I'm not sure, but obviously we're going to continue to be issuing more treasury debt, and so I think the prospects based on these two trend series is perhaps that we're going to see negative real yields, or at the worst, or maybe at best rather, we're going to have low real yields for a long time. Here's a chart that I alluded to a little bit before, and this is the implied Fed funds rate and some of the rhetoric behind this. So we've got two different data series here from two different sources, kind of talking about the same thing, but I put them both on here because they're really addressing the same topic. And that's this whole notion of when is the Fed going to raise interest rates? And we know they're very sticky, and it seems like to some that they're being very inflexible in the face of higher inflation, but they do have a dual mandate for stable prices and full employment across, and this is important for Jay Powell, across socioeconomic boundaries. And so they're willing to let inflation run hot for a while. But you can see here that, that the first rate hike is expected somewhere, by the end of next year. And then you get a second one that comes after that. Now, the probability of 2 Fed rate hikes has really jumped up since that Fed meeting. In fact, the probability as it sits right now by the end of 2022 to have not 1 but 2 Fed rate hikes is actually 50%. Here's our high yield option adjusted spread. That's kind of wonky, but let's just call it spread. So this would be the spread of high yield bonds, which are low rated, higher risk of default, non-investment grade bonds. And this is the spread of their yields over the U.S. Treasury, which is commonly referred to as a risk-free rate. And you can see that the spreads continue to fall. Now, this is very consistent with an improving economy where there's a lot of complacency, the risk of default is low, so on and so forth. So it's not necessarily a bad thing. It's just really tough to make a really strong case for high yield bonds right now. But a large part of the reason for that is this subcomponent of the high yield bond industry, and that's the energy sector, which we know we've had an increase in oil prices lately. We've had an increase in demand, which has kind of put a floor underneath prices at a point where we're not really ramping up production a whole lot. And so that's increasing the confidence within that sector that low credit bonds are going to be money good. And so they're appreciating in price as well. And their spreads are moving lower because their yields are moving lower as well because of the increased demand. So a large part of the move in high yield has been a byproduct of the energy sector. Now let's dig into the equity markets for a little bit. Here's the S&P 500, again, continuing its meteoric rise. We haven't had a 5% correction in a while, and we're very much overdue for that. And we've had a lot of money flow, positive money flow into the market. Again, it's a good looking chart. I think the long-term trend lines are intact. There's not a risk of a large risk of recession. Corporate profits are moving higher. We have a lot of enthusiasm. We've got a lot of consumer confidence. And we have a lot of liquidity in the market. Now, we are worried a little bit about the unexpected inflation, but I really think that that's probably something that could serve as that catalyst for that 5% correction. But again, having multiple of those 5% corrections within a year is extremely healthy for the market. Here's a quick snapshot of kind of that top-down view. So it's just like the old 80-20 rule. In this case, it's really the top 50 stocks in the index. We were talking quite a bit this time last year about the influence of the so-called FANG stocks, the Facebook, Amazon, Microsoft, blah, blah, blah. There's like a handful of these technology stocks during the pandemic that were high flyers and really dragged the market along with it. Now, obviously that influence has waned a little bit, but what's interesting here is just here lately, the top 50 relative performance versus the broader index has actually picked up a little bit. And I don't want to draw any hard and fast conclusions because this data series has been a little choppy here over the last few months, but just to say that the top 50 performance does matter to the S&P 500, and so we're continuing to monitor that. Here's a quick look in on sector performance. We haven't talked about sectors a whole lot, but what's really interesting here is we do see the cyclical exposure benefit. Again, we've got a chart that kind of talks about growth versus value, which I thought was really, really interesting. But you can see here where the S&P lies in the middle, and you can see communication, industrials, real estate materials, financials, and energy are all outperformers here, even though we've had a little bit of noise of late. But if you look at year to date through May, you can see these areas that have really done well. And I think in some respects, you look at materials, financials, and industrials, you're seeing a little bit of sell-off and profit taking there. But clearly energy, which is a problem child last year, has performed extremely well. Whereas, you've got, other sectors like technology that have underperformed, yet they're still showing positive performance for the year. So clearly, from a market standpoint, all cylinders are hitting. Just we're seeing that cyclical rotation here in the emerging economy. I did want to show you this because this is this whole notion of growth versus value, and growth has been a leader the last several years as the economy emerges into a new rate cycle, into a new economic cycle, you typically see cyclically exposed sectors, which are most normally aligned with value, really take off. And so I've got two charts. The one that will come after this kind of dovetails with this odd spot that we're in right now. The upper hand of this chart is just the S&P 500, and it's just the weekly index of the S&P 500. So we just saw this chart a couple of charts ago. Now, what I want to focus on is what happens in the bottom half of this, and this is the 200-day correlation between the S&P growth and the S&P value. And what's really interesting is that correlation has fallen off a table. And what does this mean? This means that growth and value are literally moving in opposite directions almost. They're not moving in the same direction, which is really, really interesting. And again, it shows this rotation that we've seen in the market. Now I want to follow that last chart up with this one, which is also extremely interesting. And this is the correlation between stocks and bonds. And so just as we saw on the equity side, that within the equity market, that value and growth are not correlated, that oddly enough, that stocks and bonds in general are much more correlated than they were. And this is obviously highly unusual because it tends to work exactly the opposite. But I thought this was relevant for noting that we just have this interesting dynamic right now. In our last slide here about the equity market, I just wanted to show something that really caught my eye. I caught it off a Twitter feed, and it made sense to me. Obviously, we've talked a lot about the increase in the price to earnings multiple in the market. We've seen where the rapid increase in earnings per share has actually brought that multiple down, and so the market's not as pricey as it once was. But in this chart, it breaks down the difference between the forward earnings per share number, and this is earnings per share. So this would be like net profit divided by shares outstanding, issued and outstanding. And that's weighed against U.S. corporate earnings after tax. And so I can draw a couple of inferences here that you see both of them moving in the same direction. Obviously, they should be related because they're both derived off of profits at the corporate sector. But what's interesting here is that we actually had an acceleration in earnings per share that's well beyond what the actual acceleration in earnings has been. And so again, you talk about this is a math issue, and so what's going on in the denominator of earnings per share? And it means that we're getting back to more share repurchase activity, supply of shares on the market. Again, kind of moving down. So we're seeing more M&A, whatnot. We're seeing more shares that are maybe issued but not outstanding, maybe held in treasury on the part of corporate America. And so what's interesting is when you lower share counts, then your earnings per share moves higher, and so that could be one explanation for why earnings per share are moving higher than just earnings after tax. And we're going to basically end on this note, and I guess we've enough time has passed, and we have good data from 2020. We can kind of take a peek into kind of what happened here within the e-commerce sector. And we know consumer spending went higher. We knew that a lot of it had to do with the e-commerce, but in various industries, looking at essentially South Korea, China, the UK, and the US, that not too surprisingly, you've had a jump in online share of retail sales. Again, the concentration of e-commerce in the total retail sales number, and we've seen a jump in all areas. Perhaps the U.S. has frankly been a laggard relative to some of these other peer countries in terms of the sheer percentage, even though the rate of growth has been fairly strong. But you look at the UK, it had a tremendous jump, and you've got these other major economies that are 23 to 26%, and the U.S. is still at 14%. It's just suffice it to say that the U.S. still has a long way to go in terms of the penetration of online sales. And even though that we're, a world leader in the development of online transaction capabilities and payment systems and whatnot, that just as an economy and as a country, we have a long way to go in that to increase that concentration. Well, that will do it for this week. I hope you've enjoyed the charts of the week. It's good to be back. We'll get back on the horse here for our weekly charts of the week. On behalf of my colleagues and the entire team at BKA Wealth, I hope you have a wonderful week, productive week, and we'll talk to you again soon.